So many governments around the world, including the United States, have been printing money in the form of relief stimulus due to the COVID-19 pandemic and economic crisis. Here in the United States, we have injected trillions of dollars into the system to prevent an economic stall. To date, we have injected about $6 trillion into the system through various administrative, legislative, and Federal Reserve actions. The question is whether or not this enormous inflow of newly printed cash will cause unwanted inflation. In this video, I'm going to make sense of it all, and I'm going to explain it in a way that the average American can understand what I'm saying. I'm sure that many of you watch or read the news and see that the government is pumping stimulus into the system in many different ways. The federal government has provided financial assistance to large companies, local governments, small businesses, and financial assistance through unemployment benefits, through direct payments to taxpayers, through tax incentives, and provided federal aid to hospital and healthcare providers. Not to mention the actions of the Federal Reserve, which has purchased trillions of dollars worth of long-term treasuries and mortgage-backed securities. So will this enormous inflow of newly printed cash cause an unwanted spike in inflation? Before I forget, I want to remind everybody to hit that like button for the YouTube algorithm. Be sure to drop a comment and subscribe to my channel. If you missed a video, be sure to go to my channel, or you can go to my website, thebeatofbusiness.com. So what is inflation? Inflation refers to the increase in the prices of goods or services over time. You're probably thinking, duh, Ravi, I knew that already. In general, economists believe that some inflation is healthy for the economy. The thought is that when the economy is growing, like when the majority of people have good jobs and unemployment is low, more consumers and businesses are out spending money, therefore increasing the demand for goods and services. Higher demand equals higher prices. As an example, let's take a $1 cup of coffee. At a 2% inflation rate, that cup of coffee will cost $1.02 at this time next year. Not a big deal, right? But what if you had a 10% inflation rate and that same cup of coffee was $1.10 next year? Still not a big deal, right? Like it's 10 cents. But if you think about it on a larger scale, let's say a $30,000 car, that car that costs $30,000 today will cost $33,000 next year, and $36,300 the next year, and so forth. But think about how that would affect an even bigger purchase, like an airplane or a manufacturing facility. In short, with inflation, the money that you hold today becomes less valuable tomorrow. Oh wait, there is one thing that is inflation-proof, and that's the Costco hot dog. It's been $1.50 since 1985. So how much inflation is considered good? Today, most economists and central banks favor a low and steady rate of inflation. In the United States, the Federal Reserve is in charge of keeping that inflation rate low and stable. As part of my research for this video, I went to the federalreserve.gov website and read the FOMC statement that was published on January 27, 2021. It reads, "The committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer run. With inflation running persistently below this longer run goal, the committee will aim to achieve inflation moderately above 2% for some time so that inflation average is 2% over time and longer-term inflation expectations remain well anchored at 2%. This is followed by what I think is a very telling statement. The committee expects to maintain an accommodative stance of monetary policy until these outcomes are achieved. Now, this tells me that the Federal Reserve is not pleased with the current inflation rate of 1.6%. It tells me that the Federal Reserve plans on continuing to pump money into the system and keep interest rates low until a desired rate of inflation of over 2% is achieved. One well-known measure of inflation in the United States is the Consumer Price Index, or the CPI. It's a broad price index that represents the overall price level for goods and services in the economy. It's managed by the Bureau of Labor Statistics, and as part of the CPI, the Bureau of Labor Statistics literally tracks the spending of 14,500 families across the country. As individuals, we may be more impacted by the rise of certain goods and services more than others. For instance, some of us may be more price sensitive to the cost of fuel than others. Some of us may be more price sensitive to the cost of healthcare than others. And some of us might be more price sensitive to the cost of groceries, and so forth. So it's important not to think of inflation and the consumer price index in terms of higher prices for just one item or service, but higher prices across the entire economy as a whole. So what's happening right now? At the moment, we have a core inflation rate in the United States of 1.6%, and that's lower than the 2% target the Federal Reserve says is needed for the health of the economy. To increase inflation, one of the things the Federal Reserve can do is decrease interest rates. If you were ever curious as to why interest rates are so low, the rate of inflation has a lot to do with it. When interest rates are low, two things tend to happen. The first thing is that banks are more incentivized to lend money in order to make money. And the second thing is that consumers and businesses are more likely to borrow that money to make purchases like cars, houses, or simply put it to use in business investments. So to simplify it even further, low interest rates tend to increase inflation and high interest rates tend to lower inflation. Since the start of the pandemic, the government has not only decreased interest rates, but they have also injected trillions of new dollars into the economy in the form of stimulus. When I was doing research for this video, I came across a very cool website hosted by the Committee for a Responsible Federal Budget. The website is called covidmoneytracker.org, and it provides you with all of the data to track the trillions of dollars of federal spending, tax cuts, loans, grants, and subsidies authorized and dispersed in the wake of the coronavirus pandemic and economic crisis. To date, the federal government has authorized about $5.8 trillion of fiscal support in response to the pandemic. Through the Federal Reserve, we have committed or dispersed $2.49 trillion in the form of loan programs, asset purchases, and liquidity measures. Through legislative actions, we have committed or dispersed $2.47 trillion through loan programs, tax policy, income support, health spending, direct payments, and state and local funding. Lastly, through administrative action, the federal government has committed or dispersed $464 billion through tax policy, health spending, income support, and disaster declaration. You would think that all of this relief spending would cause a massive spike in the rate of inflation. We'll get to that in a second. Before that, I want to talk about why it's important to invest your money. In this section of the video, I want to stress the importance of investing in assets for the long term to not only keep up with inflation, but also to grow your wealth over time. I'm not here to tell you what assets to buy, I'll save that video for another day, but assets could include gold and other precious metals. It could be commodities, it could be stocks, it could be bonds, it could be real estate, it could be cryptocurrency, or even investment grade art. Now, if you talk to 100 different people, you're going to get 100 different answers on how to invest your money. Now, just to be clear, I'm not a financial advisor and I am not providing financial advice in this video, but I do want to stress the importance of investing for the long term. Don't just let your money sit in the bank or under a mattress. Now, let's use an example to better understand the impact of inflation. Now, let's say it's the year 1991 and I'm 35 years old and I just made $100,000 in a real estate transaction. And I say I'm going to put that $100,000 in the bank and not touch it until I retire. I'm thinking in 30 years when I turn 65, I'll use that $100,000 for all of my expenses in retirement, like healthcare, like groceries, like gas, and maybe I can even pay for my grandkids to go to college. Now, 30 years later, it's the year 2021, I'm at retirement age, and I go to the bank to pull out my $100,000. The problem is that same healthcare, that same gas, those same groceries, and that college education that cost $100,000 in 1991 now cost over $190,000. So now you can only pay for your gas, maybe your healthcare, you can pay for your groceries, but your grandkids aren't going to get money for college because you didn't invest your money properly. So now it's time to answer the question whether or not inflation will increase. So after everything I just told you, you're probably thinking that inflation is going to skyrocket at any moment. With interest rates so low and so much government spending going on, it seems like a logical conclusion. But why hasn't it happened? As much as we like to think of government spending as stimulus, it should really be considered relief. The distinction between relief and stimulus is really important. Relief provides support for people while they are observing public health guidelines that require them to stay at home and lose employment. The goal of relief is to reduce economic activity and encourage people to act in ways that lessen the spread of the virus. Many economists have noted that the goal of relief was to put the economy in a temporary coma so that public health efforts could have a better chance of containing the virus. In contrast, stimulus provides incentives for people and businesses to increase spending or to increase hiring and investment. The ultimate goal of stimulus is to raise economic activity, thus increasing inflation. For many people and businesses in the United States, these economic relief efforts like the stimulus checks were used to make day-to-day payments to make up for lost wages caused by the pandemic. For the majority of people, these stimulus checks were not used to go out and make lavish purchases. So think of the economic and fiscal relief as life preservers used to prevent the economy from going into a deeper hole. You see, something very similar happened back in 2008 during the Great Recession. At that time, the federal government also dumped trillions of dollars of stimulus into the economy, and inflation did not happen. Now, that's not to say that inflation isn't happening. I mean, just because the cost of our gas, groceries, or other day-to-day purchases isn't increasing, doesn't mean that inflation doesn't exist. We only need to look at the stock market, for instance, or the real estate market, for instance, to realize that there is strong inflation in certain sectors of the economy. While the Federal Reserve expects the inflation rate to stay at about 2% for the next 2 years, who knows? Anything can happen. Who knows whether or not inflation will go up or go down? It's anybody's best guess. I just hope that by watching this video, you are better prepared for the future, regardless of your financial situation. I hope you guys learned something new today, and I hope you guys enjoyed the video. Please don't forget to like, comment, and subscribe to my YouTube channel. Thank you.